$6 trillion. Gone. Not in a day, not in a week, in 60 minutes. If you bought gold at the top this morning, I have 3 words for you. Thoughts and prayers. Silver just crashed from $121 to $108. That is $13 wiped off in the time it takes to eat lunch. Gold dumped from $500-600 to $500. $500 evaporated while you were checking your emails. And the scary part? Most people watching their screens right now have absolutely no idea why this happened. They are refreshing their portfolios, they are watching the red numbers grow, they are feeling that sinking feeling in their stomach, and they are completely clueless about what just hit them. Right now, at this very moment, someone is staring at their phone. Their hands are shaking. Their portfolio just dropped 11% in an hour. They are thinking about selling everything. They are wondering if they made a terrible mistake. Maybe that someone is you. If it is, do not click away, because by the end of this video, you will understand exactly what happened. You will know why this crash was not random, and you will see the hidden pattern that could tell you exactly what happens next. But first, let me show you something that will make you angry. This crash was not an accident. Crashes like this never are. Somewhere in the world, someone knew this was coming. The big players, the institutions, the hedge funds with access to information you and I will never see. They saw the signals before you did. They positioned themselves before the crash happened. And when it happened, they were ready. They were not panicking. They were not refreshing their portfolios in fear. They were buying. They were accumulating. They were scooping up your panic sells at discount prices. You became exit liquidity for someone else today. Let that sink in. While you were watching red candles stack, someone else was getting rich. While you were feeling sick to your stomach, someone else was celebrating. While you were thinking about selling at the bottom, someone else was loading up. This is how the game works. It has always worked this way, and it will always work this way. The question is, do you want to keep being the victim, or do you want to understand how the game is actually played? Because I am about to show you something that 90% of retail investors have never even heard of, something that professional traders watch every single day, something that could have warned you this crash was coming before it happened. But before I reveal that, let me break down exactly what happened today, the timeline, the numbers, the carnage. Today is January 29th, 2026. At exactly 10:30 a.m. Eastern Time, gold was trading at $500-600 per ounce. Silver was sitting at 121. Everything looked normal. Everything looked stable. Then it started. 10:35 a.m., gold drops to 5,550. Silver slips to 119. Nothing major, just a small dip. 10:45 a.m., gold crashes through $5,500. Silver breaks below 115. Now people are paying attention. Now the fear is starting. 11 a.m., gold is at $5,300. Silver is at 112. Panic is spreading. Social media is exploding. Everyone is asking the same question. What is happening? 11:15 a.m., gold hits 5,150. Silver crashes to $109. Liquidations are triggering. Margin calls are hitting. Leveraged traders are getting wiped out. 11:30 a.m., the dust settles. Gold is at $5,100. Silver is at $100. The damage is done. 60 minutes, $500 off gold. $13 off silver, more than $6 trillion in market value, gone. Let me put that in perspective for you. If you had $100,000 in silver at the top, you now have $89,000. You just lost $11,000. In the time it takes to watch a Netflix episode, in the time it takes to have a meeting, in the time it takes to drive to work, $11,000, gone. If you were leveraged, if you were using margin, if you bought call options expiring this week, the damage is even worse, much worse. Liquidations triggering liquidations. That is not just a phrase. That is exactly what happened today. When price drops fast, leveraged traders get margin calls. They have to sell. They do not have a choice. Their broker sells for them automatically. Their selling pushes price lower. That triggers more margin calls, more forced selling, more liquidations. It becomes a cascade, a waterfall, a domino effect of destruction. One liquidation triggers 10 more. 10 trigger 100. 100 trigger 1,000. And in 60 minutes, $6 trillion changes hands. From the unprepared to the prepared. From the panicked to the patient, from retail traders to institutions, the greatest wealth transfer of the month just happened, and most people do not even understand why. The mainstream financial media will tell you it is just volatility, normal market behavior, nothing to worry about, just noise. They are lying. What happened today is not random. It is not unexplainable. It is not just volatility. There is a reason this happened. There is a force behind this crash that most investors completely ignore. And if you do not understand this force, you will get destroyed by the next crash. And there will be a next crash. There always is. But here is what most people will miss. I am going to reveal something in this video that could change how you see these markets forever. I am going to give you a specific prediction with a specific date on the record. I am going to tell you exactly when I think silver will recover from this crash. Not a vague guess. Not eventually or someday. A specific price. A specific date. And I'm going to show you the historical pattern that makes me confident enough to put my reputation on the line. If you click away before that, you will miss the one insight that could turn today's crash into your biggest opportunity of the year. Stay with me. This is important. Welcome to Finance Currency, where I decode the real forces moving global markets while everyone else is chasing headlines. If you are not subscribed, do it right now, because what I am about to show you could save your portfolio. Now let me show you why this crash happened. And I guarantee what I'm about to tell you is something most retail investors have never even considered. Gold and silver did not crash today because something is wrong with gold and silver. They did not crash because the bull market is over. They did not crash because precious metals are a bad investment. They crashed because of something else entirely. And that something has a name, the DXY. If you do not know what the DXY is, pay very close attention, because this might be the most important thing you learn today. DXY stands for the dollar index. It measures the strength of the US dollar against a basket of other major currencies. The euro, the yen, the British pound, the Swiss franc, the Canadian dollar, the Swedish krona. When the DXY goes up, the dollar is getting stronger compared to these currencies. When the DXY goes down, the dollar is getting weaker. Simple enough, right? But here's the part that changes everything. Gold and silver move opposite to the dollar. They are inversely correlated. When the dollar goes up, gold and silver go down. When the dollar goes down, gold and silver go up. This is not sometimes. This is not occasionally. This is almost always. Let me explain this in a way you will never forget. Think of a seesaw on a playground. The dollar sits on one side. Gold and silver sit on the other side. When the dollar side goes up, the gold and silver side goes down. When the dollar side goes down, the gold and silver side goes up. They cannot both be up at the same time. They cannot both be down at the same time. The seesaw does not work that way. This is the relationship that controls everything. This is the hidden force that moves gold and silver, and most retail investors have never even heard of it. Today, the DXY pumped hard. The dollar surged against other currencies. The dollar side of the seesaw went up, and gold and silver, they got crushed. The other side of the seesaw went down. This is not complicated. This is not manipulation. This is not some conspiracy theory. This is basic market mechanics that 90% of retail investors completely ignore. They watch gold charts all day. They stare at silver prices for hours. But they never look at the dollar. They never check the DXY. They never watch the other side of the seesaw. And then they get surprised when this happens. They call it manipulation. They call it unfair. They call it rigged. It is not rigged. They are just watching the wrong thing. The professionals know this, the institutions know this, the hedge funds know this. They watch the DXY like hawks. They see the dollar spiking and they dump metals before retail even knows what hit them. By the time you see the red candle on your gold chart, they have already sold. They are already positioned. They are already waiting to buy your panic sells. You are always one step behind, unless you understand this. Now let me tell you why the dollar pumped today, because understanding the why helps you predict the next move. There are 3 reasons, and each one is important. Miss any of these and you will not understand the full picture. Reason number 1, the Federal Reserve. The Fed has been sending hawkish signals all month. For those who do not know, hawkish means they want to keep interest rates high, maybe even raise them. Dovish means they want to cut rates. Right now, the Fed is hawkish, very hawkish. Why does this matter for the dollar? Higher interest rates make the dollar more attractive to foreign investors. When rates are high, you earn more by holding dollars. You get better yields on treasury bonds. You get better returns on dollar-denominated assets. So what do foreign investors do? They buy dollars. They convert their euros, their yen, their pounds into dollars. They want those higher yields. More demand for dollars means the dollar price goes up. The DXY rises. And when the DXY rises, you already know what happens. Gold and silver go down. The Fed has not cut rates as much as people expected this year. Everyone thought they would cut aggressively. They did not. They are worried about inflation. They are talking tough. They are saying rates might stay higher for longer. The market is listening. The market always listens to the Fed. Reason number 2, China. This one is specifically bad for silver, so pay attention if you hold silver. China's industrial activity is slowing down. The latest data shows manufacturing contracting. Factory output is declining. Economic momentum is fading. Why does this matter for silver specifically? Silver is not just a precious metal. It is an industrial metal. More than 50% of silver demand comes from industrial uses. Solar panels. Every single one needs silver. Electronics. Your phone has silver in it. Your laptop has silver in it. Electric vehicles. Every EV uses more silver than a regular car. Semiconductors, AI chips, data centers. All of these need silver. And where is most of this manufacturing happening? China. When China slows down, industrial demand fears spike. Traders start thinking maybe silver demand will drop, maybe fewer solar panels, maybe fewer electronics, maybe less silver needed. Fear hits, selling starts, and silver crashes harder than gold. This is why silver dropped 11% today, while gold dropped 9%. The China news hit silver harder because silver is an industrial metal. Reason number 3, the US government shutdown, January 31st, 2 days from now. The U.S. government is heading toward a shutdown if Congress does not pass a funding bill. Markets do not like uncertainty. Markets do not like political chaos. When there is uncertainty, traders reduce risk. They take profits. They move to the sidelines. They sell first and ask questions later. After the massive rally we had this month, there was a lot of profit sitting on the table. Gold up 30%, silver up 65%. People were sitting on huge gains. A lot of those people were looking for an excuse to take profits, looking for a reason to sell, lock in some gains. The shutdown fears gave them that excuse. 3 reasons: Fed hawkish, China slowing, shutdown looming. Each one alone might have caused a small dip. All 3 together, all 3 hitting at the same moment, $6 trillion gone in 60 minutes. Now here's where it gets interesting. This is the part where I show you something that could change your entire perspective on what happened today. I have seen this exact pattern before. Not years ago, not months ago, weeks ago. December 2025. The last 2 days of the year, December 30th and 31st. Same thing happened. Almost identical setup. Sharp crash out of nowhere, panic selling everywhere, liquidations cascading through the system, red candles stacking, weak hands getting destroyed. The sentiment was absolutely terrible. Social media was full of doom. People were calling for the end of the bull market. Gold is finished, silver is done, the top is in, sell everything. Fear was maxed out, despair was everywhere. People were capitulating, and then January happened. January 2026. This month, the month we are still in, gold up 30% in a single month. Silver up 65% in a single month. Record highs broken, not just broken, shattered. The biggest monthly rally in over 40 years. All those people who panicked in December, who sold at the bottom because they were scared, who listened to the doom and gloom. They watched the rocket launch without them. They sold low. They missed everything. They transferred their wealth to whoever was patient enough to hold. Now look at today, January 29th, 2 days before the end of the month. Sharp crash, panic selling, liquidations cascading. Same pattern. Same timing, same fear. Does this look familiar? The question is, will February repeat January? Will we see another mega pump after this crash? Let me show you why I think we might. First, understand what has not changed. This is critical. The crash today was about the dollar, about the Fed, about short-term fear, about paper hands getting shaken out. But the fundamentals, the big picture, the stuff that actually matters, none of that changed, not one bit. While you were panicking, Tether was still buying 1 to 2 tons of gold every single week. They did not stop because of a 60-minute crash. They do not care about your fear. They are accumulating. While you were watching red candles, BRICS nations were still stacking. China, Russia, India, they did not sell today. They bought. They always buy the dips. While you were refreshing your portfolio, the de-dollarization trend was still accelerating. Countries are still moving away from the dollar. That did not reverse in 60 minutes. While you were questioning everything, the supply deficit in silver was still real. 5 consecutive years of deficit. Mines are still depleting. New supply is not coming. You know what changed today? Sentiment. That is it. Just sentiment. Weak hands panicked. Strong hands accumulated. And sentiment can flip on a dime. It flipped negative today. It can flip positive tomorrow. Second, look at what happens after sharp crashes in a bull market. Crashes are buying opportunities. They shake out weak hands. They reset overbought conditions. They create fear. And then the big players step in. They buy the fear. They accumulate at lower prices. They load up while retail is panicking. Then the rally resumes, stronger than before. This has happened over and over again in this bull market. Gold crashed 30% in March. People panicked. They sold. They said gold is dead. By August, gold hit all-time highs. Silver crashed 50%. People said silver would never recover. 3 years later, silver hit $50. Every single bull market has corrections. Every single one. The question is not whether corrections happen. They always happen. The question is, do you have the conviction to hold through them? Now let me give you both scenarios, because I want you to be prepared for anything. Scenario 1, the bull continues. This crash is exactly like December, a shakeout before the next leg up. February starts strong, new highs by March. Silver breaks $150, gold breaks $6,000. Probability, 60%. Scenario 2, more pain coming. The Fed gets more hawkish. Dollar keeps rising. China data gets worse. We see another crash. Gold tests $4,800. Silver tests $90. Probability 30%. Scenario 3, the chop zone. We go sideways. No new highs, no major crash, just choppy, frustrating price action for weeks. Traders get bored. Retail gives up. Then the move comes when nobody expects it. Probability 10%. Now here's my specific prediction, the one I promised at the beginning. Silver will be back above $120 by February 15th. Not by March, not by summer, by February 15th, 17 days from now. Here is why. This crash brought silver from $121 to $108. That is $13 down. That is a lot in 60 minutes. But it is nothing compared to the rally we just had. The pattern from December says we bounce. The fundamentals say we bounce. The oversold conditions say we bounce. February 15th. That is when the shutdown drama will be resolved one way or another. That is when the fear subsides. That is when buyers come back. 120. February 15th. On the record. Screenshot this. Save this video. Hold me accountable. I will make a follow-up video on February 1st. And we will see who was right. Drop your prediction in the comments. Do you think we bounce? Do you think we crash more? Do you think we chop sideways? I read every single comment. I want to know what you think. Now let me give you practical advice, because knowing what happened is useless if you do not know what to do about it. I am going to speak directly to 4 different types of people watching this video. Find yourself and listen carefully. If you are holding physical gold and silver, my advice is simple. Do nothing. Physical metal is not a trade. It is not something you buy and sell based on daily price movements. Physical metal is insurance. It is long-term savings. It is wealth preservation. You do not sell your insurance policy because the stock market had a bad day. You do not cash out your savings account because there was a market crash. Physical metal is the same. You do not have a loss until you sell. Until you sell, it is just a number on a screen. It does not affect your life. It does not change how many ounces you own. If you bought physical silver at $100, you still own that silver. It is still in your safe. It is still in your possession. The crash did not take it from you. Ignore the daily noise. Come back in 6 months. Come back in a year. The fundamentals have not changed. The long-term thesis has not changed. Only the short-term price changed. If you are trading with leverage, today was your wake-up call. Leverage in volatile markets is a death sentence. Not might be. Is. Liquidations triggering liquidations. That phrase should haunt you, because that is exactly what happens when leverage traders get caught on the wrong side. You think you are smart. You think you can handle the volatility. You think your stop loss will protect you. Then price gaps down. Your stop loss gets skipped. You get liquidated at a price way worse than you expected. Your account is gone. This happens every single time there is a sharp crash. Leverage traders get wiped out every single time. If you are using leverage on gold or silver, reduce it dramatically, or eliminate it entirely. The gains are not worth the risk of total wipeout. If you are waiting on the sidelines with cash, this might be your moment. The best time to buy is when there is blood in the streets, when fear is everywhere, when people are panicking, when red candles are stacking. That is when smart money accumulates. That is when the wealth transfer happens. From the panicked to the patient, from the fearful to the prepared, but only buy what you can afford to hold through more volatility, because I cannot promise this is the bottom. There might be more pain. There might be another leg down. Buy in tranches. Do not go all in at once. Buy some now. If it drops more, buy more. Average into your position. And only use money you can afford to lock up for months or years, not money you need next week. If you bought at the very top, if you bought silver at $121 or gold at $5,600, I'm not going to lie to you. It hurts. Watching your portfolio drop 11% in an hour hurts. I understand. I have been there. But you have 2 choices right now. Choice 1, panic sell at the bottom. Lock in your loss. Make the loss permanent. Transfer your wealth to whoever is buying from you right now. Choice 2, hold through the volatility. Wait for the recovery. Accept that you bought at a bad time. But recognize that bad timing is not the same as a bad investment. If the fundamentals are still good, if the long-term thesis is still intact, then your only mistake was timing. And timing mistakes get corrected over time. History favors the patient. But you have to survive the drawdown emotionally. You have to watch red without panicking. You have to hold when everyone else is selling. Can you do that? Only you know the answer. Now let me leave you with this. There are 3 types of people watching this video right now. The first type is panicking. They are refreshing their portfolio every 5 minutes. They are thinking about selling everything. They are letting fear drive their decisions. The second type is frozen. They do not know what to do, so they do nothing. They just watch and hope it gets better. The third type is learning. They are taking notes. They are understanding why this happened. They are preparing for what comes next. They know that crashes create opportunities for those who are ready. Which type are you? Markets are designed to transfer wealth, from the impatient to the patient, from the emotional to the rational, from those who react to those who prepare. Today, $6 trillion changed hands in 60 minutes. Some people lost that money, other people gained it. The question is, which side of that transfer are you on? If you panic sold today, you transferred your wealth to someone else, someone who was waiting for this, someone who understood the game. If you are still holding, you still have a chance. The game is not over. And if you are sitting in cash, watching from the sidelines, pay attention. Because moments like this do not come often. December crashed, January pumped, January is crashing, February is coming, the pattern is right there. Will it repeat? Remember what I said at the beginning, $6 trillion gone in 60 minutes. If you bought at the top, thoughts and prayers. But thoughts and prayers do not make money back. Understanding does, preparation does, patience does. The crash happened. You cannot change that. No amount of wishing will bring those prices back. What you can change is what you do next. What you can control is your response. Will you panic and make it worse? Will you freeze and do nothing? Or will you learn and prepare? The market does not care about your feelings. The market only rewards those who understand it, those who prepare for moments like this, those who have a plan before the crash happens. If you did not have a plan going into today, now is the time to make one. What will you do if we crash another 10%? What will you do if we rally 20%? What is your strategy? Because there will be another crash, and another rally, and another crash after that. This is how markets work. The question is, will you be ready? This is Finance Currency, where we decode the forces that actually move your money. Hit subscribe if you want to understand markets, not just react to them. Join the Finance Currency community and stay ahead of the next move. I will see you on February 1st with a follow-up. We will find out together who was right. Until then, stay calm, stay prepared, and remember, $6 trillion changed hands today. Make sure next time you are on the right side of that transfer. This is Finance Currency. I will see you in the next one.